Hi, good afternoon. Welcome everyone, and thank you for attending today's hearing. I am the Chief Actuary of the Maryland Insurance Administration, Brad Bobin. Unfortunately, Commissioner Bahrain could not be here at today's hearing, so I am leading it in her place. This is the second quarterly public hearing of 2023. That is going to be discussing carrier rate increase requests for long-term care insurance. Today's hearing includes 4 companies requesting rate increases in the individual and group long-term care markets. These requests include John Hancock Life Insurance Company, proposing an average increase of 139.1% for all insureds under policy forms LTC-02MD, BSC-02MD. They're requesting 80.6% for all insureds under policy forms LTC-03MD, BSC-03MD. They're requesting 82.9% for all insureds under policy forms LTC-03MD parentheses 2007. They are requesting 47.4% for all insureds under policy forms LTC-03MD1/08, 35.9% for all insureds under policy forms LTC-03MD6/10, and 55.2% for all insureds under policy form LTC-06MD. And finally, 36% for all insureds under policy forms ICC-10-LTC-11. Knights of Columbus is proposing an increase of 37% for all insureds under policy forms LTC-01 and NHC-01. The Prudential Insurance Company of America is proposing an increase of 15% for all insureds under policy forms GRP 1126008, GRP 99507, GRP 99508, GRP 99509. And they are requesting 14.5% for all insureds under policy form GRP 113252 REV. And they are requesting 14.6% for all insureds under policy form GRP 113252 and GRP 113252 ED 05-2010. And finally, Transamerica Life Insurance Company is proposing an increase of 81.5% for all insureds under policy form ICC-10 TLC-3. And then today's hearing also includes a request in the group long-term care market from the Prudential Insurance Company of America, proposing an increase of 4.9% for insureds under policy form 83500 COV 5030, and 15% for those under policy forms 83500 BFW 5018 and 83500 GR 1067. These requests in aggregate, impact 17,152 Maryland policyholders. The purpose of this hearing is for insurance company officials to explain the reasons for the rate increases and for the MIA to consider whether the proposed rate increase is in compliance with Maryland's laws and regulations relating to long-term care insurance. We will also listen to comments from consumers and other interested parties. We are here to listen and ask questions of the carriers and consumers regarding the specific rate increase requests. I would like to take a moment to introduce a couple of my colleagues. On the phone with us is Craig I, the Chief Communications and Public Engagement Officer. He's helped put together this webinar, and if there's any comments that you have, he is the one to reach out to. And then I would also like to introduce Jeff G, who is the senior actuary who manages long-term care for our department. And then I'd like to go over a few procedures, please. So when it is time for public comment, we will first call on members of the public who have registered to speak in advance. To the extent the time and technology permit, then the MIA will hear from any unregistered participants who have accessed the Zoom webinar platform. If you would like to speak and sign up, if you could please utilize the chat function in the Zoom platform and indicate that you would like to speak. And then Craig will be able to give you an invite to a link to allow you to go from being just a viewer to being able to ask your question. With the exception of the MIA staff, this hearing is not a question and answer forum. So, comments from interested parties have been received and reviewed in advance of this hearing. We will keep the record open for another week after this hearing. So if anybody would like to submit any additional written comments, you can contact us by May 30th, and they will be entered into the record and published on our website. A video of today's meeting, as well as all written testimony submitted, will be posted on our website on our long-term care page. It can be found on the MIA website by clicking on the Consumers tab on the top of the homepage, and then clicking on the long-term care link. To help ensure excellent sound quality throughout the hearing, we ask that anyone who is not speaking, please stay on mute. If you have technical difficulties during the hearing, please reach out to Craig I via direct message or email. His email is in the chat. Also, anytime before speaking, if you could please restate your name and organization clearly for the record, that would be a great help. We're going to ask the carriers to speak first and then move on to the public. Carriers are going to be called in an A to Z order. And afterwards, any interested stakeholders will be invited to speak. Before I turn it over to the carriers, Jeff, is there anything that you wanted to say at this time, or are you going to wait for questions?
I'm good so far.
All right, great. All right. At that point, then we are going to move on to the carriers. If the representative from John Hancock Life Insurance Company could please speak first.
Yes, thanks. Good afternoon. My name is PJ Beltramini, and I'm a vice president and an actuary at John Hancock, responsible for long-term care insurance in force management. I'm in good standing with the Society of Actuaries and the American Academy of Actuaries. Brad, Jeff, Craig, thanks to you and the rest of the team for holding today's virtual hearing and for providing John Hancock this opportunity to discuss our long-term care filings currently pending with the Maryland Insurance Administration. We understand that it is difficult for insurance departments to balance the impact on their constituents with maintaining a private market for long-term care needs, so we appreciate your time on this matter. John Hancock began selling long-term care insurance as a guaranteed renewable product in the state of Maryland in 1987. We currently insure over 20,000 long-term care customers in Maryland and have paid out more than $650 million to Maryland families as of December 31st, 2022. Nationwide, we pay over $1.7 billion of long-term care claims per year. We take our commitment to our customers very seriously. This includes making significant ongoing investment in our service capabilities, as well as piloting wellness programs with the goal of helping our customers live healthy and independent lives. I'm here today to speak specifically about our long-term care premium rate increase filings that are pending with the MIA. John Hancock understands premium increases can be difficult for our customers and appreciates the opportunity to explain why these rate increases are needed. I will also discuss the various options we offer to mitigate the rate increase and how we will communicate those options to our customers. We currently have 7 rate increase filings with the MIA for multiple policy forms that were sold in Maryland between 2002 and 2012. The rate increase request amounts range from an average of 36% to 139%, depending on the policy series. These filings were submitted on April 26, 2023, and will impact approximately 10,000 Maryland insureds. Acknowledging Maryland regulation, John Hancock would be willing to work with the MIA to implement the requested rate increases over multiple years with no more than 15% increase in each year. I want to explain why we need these rate adjustments. John Hancock is committed to helping ensure LTC insurance benefits will be there for our customers when they need them most. To uphold this responsibility, we continuously monitor the experience of our in-force LTC insurance policies and conduct a comprehensive claims study, generally every 3 years, to examine the usage trends for our insured population. Relative to our previous expectations, the new data in our 2022 comprehensive claims study found lower mortality for non-claimants, higher utilization of benefits, and longer claims, partly offset by lower claim incidence. Based on that data, as well as data from previous studies, we have determined that there is a need to increase premiums on certain policy series so we can meet our future claims obligations. Our rate requests also reflect the timing of the acceptance of our prior rate increase filings in Maryland, as well as any unapproved amounts from our prior filing on an actuarially equivalent basis. I would now like to turn to how we can help our customers mitigate the impact of a rate increase. We are aware that customers appreciate alternatives and are committed to providing our customers with options which will help them mitigate the impact where possible. We provide the standard benefit reduction alternatives to mitigate the impact of premium increases. These include reducing the daily benefit and/or the benefit period, increasing the elimination period, or dropping optional benefits. Additionally, when we receive a full or substantially full approval of our request, we are able to offer most customers one of our actuarially equivalent mitigation options, landing spots and shared cost. The first option, known as the Future Inflation Reduction Landing Spot, offsets the rate increase for those with fixed automatic inflation increases by lowering the future inflation increases on a prospective basis. The customer retains their current daily benefit amount and any past inflation accruals, and only the future accruals are reduced. Our second actuarially equivalent mitigation option, called shared cost, also provides a meaningful alternative to our customers. This option is particularly beneficial for older customers who have paid many years of premiums because the ratio of future benefits to future premiums is higher for those individuals. The higher that relationship, the lower the shared cost benefit reduction has to be to offset the rate increase. The shared cost option has 2 components. First, the current policy maximum benefit amounts will be reduced by the shared cost percentage. And second, the customer will agree to pay the shared cost percentage, which is similar to a coinsurance percentage on every future claim. Finally, with this filing, we are introducing an LTC buyout offer and policy termination option. If the customer elects this option, they will receive a payment in exchange for terminating their policy. If elected, this option will terminate the policy effective immediately. Once the policy is terminated in exchange for the payment, the policy will no longer be active and cannot be restored. This offer will only be available on certain policy series and for insureds who purchase their policy below age 70. We recognize that these options are, in fact, benefit reductions. Nevertheless, they provide viable options for customers who may choose not to pay the premium increase, but do not want to lapse their coverage. We understand the value of these policies and fully appreciate the inconvenience and potential challenges that these rate increases present for our customers. We believe in clear communication with our customers, describing the need for these rate increases and the options they have to mitigate the increase. As supporting documentation to our rate filing, we have submitted a sample customer communication package regarding the rate increase and options to help mitigate the rate increase. We developed this communication package keeping in mind the amount of meaningful and detailed information to the customer and the presentation of the material in a clear manner. We have incorporated suggestions from state regulators, customers, and our dedicated customer service representatives. This package will be personalized for each customer with reduction options to keep their premium at or near the current level, and the options will vary by their respective situation. In conclusion, putting our customers first has been and continues to be a critical component to everything that we do, and we appreciate this opportunity to address our current filings with you. I'd be happy to answer any questions that you may have.
Thank you very much. Jeff, do you have any questions?
Yes, I do. The first one is for the shared cost option. Have you submitted the form filing for this option, and when?
I believe we have, but I will have to take that back. I'm not certain whether it's submitted.
Oh, okay. Yeah, that would be great. Another question is, I saw some of the products, the prior filing, we rate increase filing, we approved around the year 2018. And then I'm not sure why you wait around 5 years to resubmit the follow-up rate increase requests.
Yes, for some of the series, that is the last time the rate increase was submitted and approved. There are some of the series that did not surpass the moderate margin when we filed the last time, and so we didn't submit those.
Okay, so are you saying you changed margin assumption, or you changed some pricing assumption, rating assumptions?
Yes, I should be clear. We didn't change any of the margin assumptions. Those are all the same for each of the series as they have been since issue. What I was referring to is the underlying liability assumptions effectively.
Okay. Okay, thank you.
All right, thank you, Jeff. I had a couple questions myself. So you referenced that the rate increases range from 36% to 139%, and the policies were sold between 2002 and 2012. There's a negative correlation, right? That the higher increases are for the older policy forms, and the lower increases in general are for the newer policy forms that were set with newer assumptions that have missed by a lower magnitude.
Yes, that's generally correct. Yes.
All right, thank you. And can you confirm that if these increases were to be approved, that you would not intend to seek further increases unless assumptions deteriorated significantly more in the future, that this is the full increase and there are not planned future increases beyond this?
Yes, that's correct. If the filings are approved as submitted, this is the only increase that we would plan, unless, to your point, we will see deterioration in our expectations for the future.
All right, thank you. I had a couple questions about your reduced benefit options. You talked about the inflation landing spots. Can you clarify, is that going to be an inflation rate calculated to keep the premium at this same level, so it would be different for each policyholder depending on their specifics?
Yes, there'd be various subclasses. It wouldn't be different for every policyholder, But based on their prior election of landing spots, it might be different for them. But the goal would be to keep it at a premium neutral level, keep them at the current premiums.
All right, and do you have a way to estimate the range of what those alternative inflation would be, and give us a summary? You know, obviously not maybe everything, but you know, some kind of detail about those anticipated inflation landing spots.
Yes, that's something we can certainly take away and provide.
All right, great. And then I had a question about the buyout offer. How is the buyout amount going to be determined for those policyholders that get one of those offers?
Yes, so at the highest level, we'll look at our GPV, gross premium valuation reserve, which is our best estimate calculation for each policy. And then we'll look at the present value of benefits that's determined for each of those policies. And then we'll take a present value, I should say a percentage of the present value of benefits for each individual policyholder. And I guess I should add also that that percentage will be the same within a given policy series.
All right. You said that not all the policy series that you filed are going to have this offer in it, but certain of the policy series do, correct?
That's correct. I believe the first three that you listed have that option, and the last four, I believe, do not.
All right, but then within a policy series, if they have it, everybody that meets the criteria of having been issued below age 70 will get it. There's no further restrictions beyond that, correct?
That's correct.
All right, thank you for that clarification. All right, I think that's all the questions I have right now. Thank you very much for your time and your testimony today. And we'll be following up about those inflation spots in SURF. Thank you for that.
Okay, thank you all.
All right, next, if we could please have the speaker representing Knights of Columbus.
Good afternoon. My name is Ron Franz-Livers, and I am Senior Vice President and Chief Actuary for the Knights of Columbus. Mr. Boban, Mr. I, Mr. G, thank you for the opportunity to speak regarding the long-term care rate increase that has been requested by Knights. Knights of Columbus is a fraternal benefit society that offers a variety of insurance products, including long-term care insurance with members and spouses throughout the United States and Canada. Knights of Columbus has sold long-term care insurance since the year 2000 and continues to offer the product today. We currently provide LTC coverage to over 52,000 insureds in the United States, with about 1,700 of those policyholders in the state of Maryland. As documented in our recent rate filing, Knights of Columbus is requesting a 37% rate increase on its first generation of long-term care policies. Those are policy forms LTC-01 and NHC-01, as well as their associated riders, which were sold in Maryland from 2000 to 2000. The requested increase would apply equally to all insureds of these policy forms. It should be noted that this is the first long-term care rate increase ever requested by the Knights of Columbus. And if approved in Maryland, the increase would be phased in over 3 years to comply with the state requirement to not exceed a 50% increase in any 1 year. The company would then implement an increase of 15% per year for 2 years, followed by a 3.59% increase in the 3rd year in order to compound to a cumulative 37% increase. As of year-end 2022, there were 1,348 policies issued in Maryland that would be impacted by the requested rate increase. As a fraternal benefit society, Knights of Columbus has been reluctant to request premium increases on its long-term care insurance products due to the burden it would place on its members who are the policyholders. As mentioned, this is the first increase that was requested by Knights of Columbus on any long-term care policy. The increase is being requested due to variances in past and projected experience from what was assumed in the original pricing. The increase is necessary to ensure that Knights of Columbus will be able to meet the future long-term care benefit promises made to its policyholders. It should also be noted that this increase was first filed through the recently developed NAIC multi-state actuarial rate review process for reviewing LTC rate increases. Multi-state actuarial team reviewed the rate increase filing thoroughly and recommended that states approve the full 37% increase. Knights of Columbus will provide policyholders impacted by the rate increase with individualized notices that describe the premium rate increase, as well as potential options to modify benefit selections that could help mitigate some or all of the premium increase. These options may include a reduction to the policy's benefit period, an increase to the policy's elimination period, or a reduction to the daily benefit amounts. Notices will be mailed to policyholders 90 days in advance of each premium increase effective date to give policyholders ample time to consider their options. Notices will also provide a toll-free telephone number to allow policyholders to contact trained customer service representatives who can assist with premium quotes for additional benefit reduction options and any related questions the policyholder may have. In addition, the company is making available the contingent benefit upon lapse non-forfeiture benefit to all policyholders impacted by the rate increase at each step of the rate increase, even though the level of increase requested would not always invoke this provision. Thank you for your time and consideration of this request, and I'm certainly happy to answer any questions you have about this matter.
Thank you very much. Jeff, would you like to go first? Do you have any questions?
Yes, my question for you is for MI, we barely approve any filing with a lifetime loss ratio below 80%. So if we approve your 37% rate increase, the lifetime loss ratio will be below 80%. So to offset that, can you convert, if we approve 37% rate increase, can you convert this policy to non-cancelable policy, which means you will not pursue any other future rate increases anymore in the future?
Jeff, let's you and I talk offline about that. I don't think that's an appropriate question right now.
Oh, okay. Okay, then I'm fine. So then I don't have any other questions.
All right, thank you, Jeff. I just had a couple questions. First, could you please describe the major assumptions that have been updated since the initial pricing that are driving this 37% increase?
Certainly. So our block is fairly new. We started selling in 2000. So a lot of the morbidity assumptions are really starting to develop more fully at this point. And a lot of what we're seeing on the horizon are greater incidence rates for older individuals versus what was originally assumed. So it's sort of the storm cloud brewing on the horizon scenario where we're seeing that those incidence rates are much higher than what we expected. That's going to cause a larger problem in the future. And I'll be honest, part of it is the interest rate environment certainly is different than what the products were originally priced at. So that contributes to where we are today. It is absolutely true that our current loss ratio is in a pretty good place right now, but it's projected to not be in a good place in the future, and we're trying to head that off before it becomes an even bigger problem.
Thank you. And so right now this reflects your best estimates. And so if you got the 37% approved, you would not intend to ask for an additional increase unless and until you got data to show that your assumptions needed to be updated again, correct?
Yes, that's absolutely right.
All right. Thank you. So you mentioned a non-forfeiture option. How is the value of that going to be computed?
As I remembering it off the top of my head, we take the premiums that have been paid and create a benefit that is based on those premiums for a shorter period.
All right, do you know if you offset for any claims that have been paid?
It would be offset for any claims that are already been paid.
All right, thank you. And then you mentioned the MSA, the multi-state actuarial review. And you know, that's certainly a, you know, a unique and you know, this is our first MSA filing outside of the pilot program. I don't think we've talked about the MSA work group at any of these public hearings. You know, as you mentioned, you know, it's a multi-state work group where actuarial long-term care experts perform an independent review. It was recently piloted, and you know, we are now outside of the pilot range. And it is voluntary for carriers to submit to the MSA, and the report is not binding on any state, but you know, it provides, you know, good analysis and context for state regulators to review. Could you just speak to your decision to submit it via the MSA, and would you intend to submit any needed future increases via MSA, or will it depend on how this works out for you?
Sure. Yeah, thank you for the question. So I'll take the latter first. I think any future increase, while we hope that never has to happen, would have to be evaluated at that time under the circumstances. Our decision for this rate increase, this first rate increase, to go through the MSA was really driven primarily due to trying to treat all of our policyholders across the country, truthfully, in a fair and equitable manner. As we know, each state requires a rate increase filing, and for Fraternal Benefit Society, we would like to give the same deal to as many people as possible. So if there's a dramatic difference in the rate increase allowed in different states, then that's not really what we're trying to do from a fraternal standpoint. So even though it was more time and effort on the front end to go through the multi-state review process, we thought it was worth it coming out of the back end if it increases the probability that the states will be closer in what their ultimate rate increase will be.
Thank you. And then you acknowledge that you're constrained by our 15% annual rate increase, and that you would intend to implement the 37% over 3 years. You mentioned 15% in years 1 and 2, and 3.4% or so in year 3. Would you be amenable to an alternative schedule that was more even across the 3 years, of like 11.2, 11, 11, instead of the structure that you mentioned?
I'm sure we would be amenable to.
All right, thank you very much. Thank you. I appreciate your testimony today. Thank you for your time.
Right.
With that, if we could please have the representative from Prudential Insurance Company of America.
Hello. Seems I'm not able to start my video. Can you hear me though? Oh, there.
Yes, we can hear you fine. Now we can see you as well.
Okay, great. Thank you. Hello, my name is Michael Zilberman, and I am a director and actuary at the Prudential Insurance Company of America, focusing on long-term care repricing. I'm a fellow of the Society of Actuaries and a member of the American Academy of Actuaries, in good standing with both. The Prudential Insurance Company of America is currently seeking approval for rate increases on its individual and group policy forms. The amount we requested has been capped at 15% for each product to adhere to the administration's regulatory caps. However, as shared in the actuarial memorandum, the rate increase is required to achieve nationwide rate parity or higher for most products. Accordingly, we would appreciate the opportunity from the administration to implement them using a phased approach that caps each year at 15% to remain consistent with the regulatory cap. Prudential is varying the ultimate rate increase amounts in such a way that considers the material difference in risk captured by each product's unique benefits. For our individual products, this results in stratification by type of inflation benefit, length of the benefit period, and whether policy benefits are paid by reimbursement of claims or via one of our cash riders. For our group products, the rate increase amounts on most insureds will vary by the type of inflation benefit. In each case, the requested amounts are configured to better match our emerging experience and loss ratio expectations. Prudential is seeking premium rate parity across all states. Consequently, the ultimate rate increase amounts shared in the actuarial memorandum are intended to ensure that Maryland insureds pay premiums that are similar to those in other jurisdictions. There are 1,702 individual and 3,826 group insureds that own policies subject to this rate increase request. Our desire to achieve premium rate parity means we are not currently seeking to recoup lost time value of money from delays in rate increases. However, we believe that timely approval and implementation of the required increases is crucial to ensure our customers in Maryland can keep the coverage they find valuable while contributing premiums that are equitable compared to other jurisdictions that have approved our rate increases in full. Prudential's rate increase requests reflect our emerging adverse experience in several areas, including voluntary lapse rates and mortality. Our ultimate voluntary lapse rates vary by factors such as marital status and policy inflation provision, but in aggregate are approximately 0.7% for Prudential's individual business and 0.8% for Prudential's group business. This compares to the 1.5% to 6% that was assumed in the original pricing, depending on the product and benefit cohort. In addition, mortality experience is lower than originally expected for both individual and group products. Due to lower voluntary lapse rates and mortality, it is projected that a significant number of insurers will remain in force during their older attained ages when they are more likely to go on claim. Prudential is committed to evaluating our experience on an annual basis. The process to review experience and set assumptions at Prudential is not taken lightly. It starts with gathering detailed policy by policy experience data for voluntary lapse rates, mortality, and morbidity, and comparing to pricing expectations. The actual to expected results are analyzed for trends and compared to current assumptions. Industry data is also analyzed where applicable and available. The analysis of experience and proposed updates to assumptions are reviewed within internal LTC actuarial management for assessment of the actuarial soundness of methodology, calculations, and judgment utilized in development of proposed assumptions. Once internal LTC actuarial management review is complete, a mandated Prudential enterprise review and approval process begins, ultimately passing through several levels of assumption and insurance risk oversight committees before being approved by the Prudential chief actuary. Prudential understands that these rate increases can be challenging for some insureds. In order to assist our customers with these challenges, our policyholder notification letters offer a number of benefit reduction options to mitigate the impact of rate increases while maintaining a valuable level of coverage. Additionally, we include an option to stop paying premiums and exercise a paid-up non-forfeiture benefit, which is available to all insureds regardless of their issue age or the size of the rate increase. The notification letters also include a toll-free number to ask questions or request additional benefit reduction options not shown by default. The customer service representatives in the call center have been trained to handle rate increase situations and are 100% dedicated to Prudential long-term care matters. Of course, all insureds are also given the option to pay the increased premium and maintain their existing benefits. While benefit reduction options are available to many of our customers, experience from recent years shows us that Maryland insureds strongly value their coverage. Since the last rate increases for these products, only 5% chose to reduce their benefits, 1% lapsed their coverage by exercising a non-forfeiture option, and 94% chose to accept the rate increase with no benefit changes. In 2022, our insureds on claim were paid an average of $55,000 in LTC benefits, whereas the average annual premium for these claimants was only $4,100, an amount that is waived once they enter claim status. Thus, even with the rate increases requested, the coverage our insureds have holds immense value that can make a real difference in a time of need. In conclusion, Prudential is committed to doing as much as we can to help protect our customers' financial futures in Maryland and nationwide by responsibly pricing and reserving for our products. We appreciate the administration's time and attention to this matter and are available for further discussion.
Thank you very much. Jeff, do you have any questions?
Yes, Mr. Zimmerman, so from your actual memorandum, I noticed that for all your filings, you are using COMAR requirement for 15% cap each year.
Yep.
So currently, all your rate increases is either at 15 or below 15%. However, for those below 15% rate increases, I noticed in your actual certificate, you said take a look. Looks like you said you cannot bear me a little bit.
Sure.
Yeah, you say you cannot make, well, with the exception, the Prudential is not currently provide a certification that new future increases are anticipated under moderately adverse experience. So I was wondering why.
Sure. So we don't include a margin for moderately adverse experience in our projections by default. We're happy to show that. We're also, our rate increases are justified based on best estimate assumptions. But essentially, we just don't include that certification by default. In cases where the full rate increase that we need is going to be approved, we are happy to provide it, as we're pretty comfortable that if those full rate increases mentioned in the actuarial memorandum are approved, the ones in excess of 15%, that we do not plan on coming back for any more.
Okay.
So on that topic, I think there's some administrative confusion, and that I'm going to ask my staff member Nancy Malberger to work with you. I mean, if your intention is to be filing for the increases that you need, subject to the 15% cap, then I think we want to change what's in SERP, and we're going to need a post submission update. I think right now it's filed, you're asking for 15%. And if we approve the filing as it is, you've talked about your future intentions, but you would have to file those separately. If you want us to consider, the ultimate increases that you're asking for phased in, subject to the 15% increase, then I think we're going to have to change how things are filed right now. So that is your intention. Then, I personally like that intention. I mean, I see in the past we've approved 15%. One at a time, and I think it's better for the policyholder to know in advance that this is what is ultimately needed to get the premiums to where they need to be. So it sounds like that's your intention, correct? Filing the numbers that you've referenced in the memo.
Yeah, absolutely. I wasn't sure offhand if the administration was currently approving multi-year rate increases, so we filed with the 15%. To make sure we were in compliance, but that's why I wanted to share those numbers as well. And we're happy to amend the filing accordingly. Yeah,
and I mean, it's obviously a case-by-case basis, and depending on the circumstances of filing. But yeah, I mean, we are certainly considering increases over 15%, and are approving some increases, phased in over multiple years. And so yeah, I will have my team reach out to you in SERP about amending things to reflect the ultimate increase that you're looking for. Sorry to interrupt, Jeff. Did you have any additional questions that you wanted?
Yeah. So when you include the MAE, we would like those MAEs be consistent from filing to filings. I mean, from prior filings. Such as if you originally pricing, you don't have an MAE, then we probably gonna make comparison without MAE too. So just we want everything consistent from time to time, so that we can have a very clear upward to upward comparison. So just for your information.
Yep, sounds good. Appreciate the info.
Thank you.
All right, thank you, Jeff. All right, I had additional questions. So you mentioned that all policyholders will be offered a non-forfeiture option. Is that going to also be calculated as the present value of premium, or of premiums paid to date minus any claims paid to date? Yes,
right. It's a paid up benefit, including the sum of their premiums paid to date, and I'm I'm not sure about the claims piece, but we could look into that and answer that for you.
All right, yeah, we would want clarification, I think, in SURF, whether you're gonna offset it with claims paid or not take that into consideration, because it's done both ways. We see some benefits, do offset with the claims and some do not. So I think we would want that clarification.
Yeah, of course.
In SURF. All right, thank you. Other than that, I think you've explained things pretty well, and I don't have any additional questions at this point. So thank you very much. And our final carrier representative, if we could please have the rep from Transamerica Life Insurance Company.
Yeah, good afternoon. Thank you very much for the time. My name is Matthew Amon. I'm Senior Director of State Government and Policy Affairs at Transamerica. Also, as you can see with his beard when he goes on video, is Brad Rokash, who's the head of our financial assets health team at Transamerica. Again, appreciate the opportunity to be here. We think these hearings are important for the carriers to have an opportunity to be transparent and talk about what we're seeing in our blocks. What we wanted to discuss, our filing to discuss today, is our uniproduct 2A policy form written by Transamerica Life. The rate increases would affect 207 policyholders with annual premium currently of approximately $400,000. These policies were issued from 2011 through 2013 in Maryland. Transamerica is seeking an increase of 81.50% on this policy form. Given the statutory cap and to remain in compliance with that, we would ask to spread that rate increase across 5 years. As you've heard from other carriers, this is an important block of business for Transamerica. These customers are important to us. We want to actively manage this business to ensure our policyholder promises and obligations are fulfilled. As we all know on this call, carriers like Transamerica made several assumptions when these policies were sold. Over time, as claim experience developed, those expectations have changed and evolved, which has resulted in updates to key pricing assumptions, which have deviated from those original expectations. As Transamerica and industry experience has shown, more policies are keeping their policies longer than originally anticipated. Certainly, customers value this coverage, but it also leads to significantly more claims than anticipated. In addition, increasing costs of long-term care services, people living longer, and people staying on claim longer than expected are causing increased overall costs of long-term care payments. While these reasons are not unique to Transamerica, we do believe we have a responsibility to do everything we can to manage this block of business by monitoring this experience, which supports the development of future assumptions and expectations, which then we believe supports our justified rate increases. Similar to the other carriers, Transamerica is committed to providing policyholders with alternatives to rate increases where possible. And we understand the value of these policies. We understand the inconvenience and potential challenges that the rate increases might present. So we believe that communications to policyholders are crucial. Describing the need for these rate increases is important. We also need to provide flexibility and options for the policyholder. Transamerica offers a whole slate of potential benefit reduction options or benefit changes that our policyholders can take advantage of to try to reduce or offset the rate increase. In addition to what I would term traditional downgrade options, we also provide a contingent non-forfeiture benefit option. Plus, we are introducing a cost-sharing option with a 5-year rate guarantee for policyholders who elected. Again, thank you very much for the opportunity to speak today, and I'll stop there and see if you have any questions for Brad.
Thank you. Jeff, do you have any questions?
Yes, the question for me is, so after you requested a rate increase, the lifetime loss ratio would be around 73%. At that level, I would like to know how much of the loss you're gonna absorb by the company, and then what percent gonna be transferred to the policyholders.
Well, I think this is Brad Rokash from Transamerica. So I think our current loss ratio is in the upper 90s. So if we did get the full 81.5% rate increase, it does drop to around 72% from a loss expected in the future lifetime. It was originally priced in the mid 60s. So we're kind of more in that break even range, slight profitability for this product, which is, we believe is acceptable. It's earlier, if we can act earlier on these newer generation of policies, it decreases the rate increases for the policyholders and a little more transparency on what is needed going forward for the consumers. So.
Okay, thank you.
Thanks, Jeff. I had a question about the cost sharing option with the 5-year rate guarantee. Could you give a little bit more detail about how that rate guarantee works?
Yeah, the rate, if we get to an acceptable agreement with the MIA, the rate guarantee would allow these individuals who elected this to participate in their policy. So it's similar to like a co-insurance with the health insurance. Let's use an example of 20%. They would share on the cost of future rate increases, and they would offset this full rate increase. And within this time period, we have to come back for a rate increase. They would not receive that rate increase over the 5 years. After the 5 years, they would potentially get any future rate increases, but it gives that policyholder that predictability where their rates will be for the next X amount of years. And that rate guarantee would apply after the rate increases are fully implemented. So it's a little longer than the full 5 years as outlined. Since we're spreading this over X amount of years, that rate guarantee would happen after that period of time. And maybe that's probably not that clear in the filing.
All right, but the rate guarantee is only for those that elect the cost sharing option, right?
Anybody elects the cost sharing option.
And the cost sharing option is going to offset some of the premium increase, I guess, but not all of the premium increase.
It should.
That the value
Well,
of the guarantee,
yeah,
it offset the whole increase.
Depending on which type of benefit you had, certain combinations, it does vary by benefit period and bio. And there are cells where they're completely offset versus there might be a little portion of the rate increase left. We have not provided the department the final numbers. We're just kind of waiting to see where you guys land on a rate increase. And then we would potentially offer that to your consumers. So.
Okay, thank you. So if you get the increase approved in full, you would not intend to file again unless assumptions deteriorated and got worse and you needed to update things.
Yeah.
Is that correct? Or would there be a possibility of an increase even
Right
without
now,
assumptions getting worse?
we are filing with a 10% margin in our projected results. So, experience would have to deteriorate further than that to warrant us to come back to the department for additional rate increases.
All right, thanks for that clarification. I think that's all of the questions that I had. All right, thank you very much for your testimony, everyone. At this point, we're going to move to public testimony. I know that in advance, we had a Mrs. Betty Legundo sign up. Craig, has she joined the call today?
I just sent her a panelist invite. So she should be joining. Ms. Legundo, can you hear us?
Yes, I can. Hold on, I'm trying to get everything started here. It blinked out on me and then it came back. It won't let me, oh, there, start video, okay. It's not letting me do my video for some reason. Oh, okay, I have to hit this up here, maybe. There we go. Oh, it's not the right camera. I'm sorry, you're gonna see my ceiling. This does this to me on Zoom for some reason. I'm not sure if I can change it or not. Let's see.
Well, we can hear you fine, Ms. Legundo. So if you just want to give your testimony without video, that's fine, but it's up to you.
Yeah, we can stop the video. That'll be fine. And then you can just.
Okay.
Yeah.
Well, I just thought you should be able to see me since I can see you. It did let me switch it, but it didn't switch. Let's see. Anyway, front camera, maybe that's the thing.
There we go.
All right, here I am. So I attended the hearing back in 2019, I think it was, for the John. I'm a John Hancock customer, and all of my questions would be for you guys and them. One of the things that I'm totally confused about is the whole policy series thing. Is this going to affect my policy or is it not? Because on my original paperwork, my series is LTC 96. So I'm not even sure that this rate increase request is affecting my policy. Is there anybody can answer that?
Yes, my team can definitely answer that.
Okay.
It's not on a list of policy forms that we read, so I would think that the answer is no, but I can certainly have my team investigate more fully and track down if it is associated with any of these rate filings.
Okay. I had submitted a complaint back in February because I had, in 2019, they agreed to you all capped them at 12% per year. And I chose the mitigation to lower my inflation rate from 5% to 4.1%. And in doing so, that kept my rate at the same rate for that 3-year period of 2019, 2020, 2021, and 22. So then I got a letter for my 23 bill back in December, and it said that now the rates are going to go up again in the next 3 years unless you choose one of these mitigation strategies. So one was to drop to 3.1% inflation rate. One was the this thing that's a new thing you guys keep talking about the I guess the termination or the what is it called?
The non-forfeiture option.
Yes, that. And at which point I didn't quite understand that, other than they would pay me out like $87,000 or something, or I could just stop making payments, and if I ever went into a nursing home, they would pay up to that amount. That was one of the options. And then another option was to lower. I called them because I thought, well, there are more options, and one was to change it to like 10 years instead of lifetime, because I have a really good policy. I have a lifetime policy, but my biggest thing is, when are the increases going to stop? Because as of today, and I sent this spreadsheet to you, as of today, my policy has already increased by 227%. In other words, 127%, I guess, in addition to the original amount, which was, $2,250, I think it was originally. If it keeps going at this rate of 15% per year, that's the other thing. And instead of mitigating, if I chose a mitigation strategy, it only kept it at the same level of the 4202 that I was paying before for 1 year, not 3 years. So I'm thinking in my head, okay, if I keep giving up something every year to keep it at this cost, pretty soon I'm not going to have a very good policy, or what would be the point in having it? So I'm a little disgruntled about it all. I understand they made some bad projections in the beginning, but I'm pretty fortunate that I can still afford to do this. There's probably a lot of people that cannot. I mean, paying out this is just this. I have property taxes I pay every year. I have, other insurance, car insurance I pay every year. So, I mean, where is the thing going to end? They said they're going to keep increasing it 15% a year for the next 3 years till it's $6,392 in 26 or 25. I'm sorry, 23 to 45. And then after that, supposedly this was already approved. I don't know. I wasn't at any meeting where it was approved. I wasn't told it was approved. And when I sent in my complaint I got it back from Autumn that, yes, it's been approved. These are the correct amounts and all like that. But, so now I guess, are they going to raise my rates anymore after this? Since that my policy is not included in this current request, because they haven't asked to raise my rates anymore. So where, is there ever going to be a point where they don't, I guess is what I'm asking.
Thank you. It does sound like, based on what you're saying, that your policy is not part of this rate hearing. And is a part, what was part of another hearing that had this rates approved. I will have my team investigate. I had your complaint sent to me today. To your general higher level question of, when will the rate increases end? That is difficult to say with certainty, but, in general, we are reviewing all of these rate filings very carefully. And under Maryland law, we are charged with ensuring that rates are not excessive and that rates are not discriminatory and that the rates are not inadequate. And, the inadequate part is, unfortunately, what is most at play with these long-term care policies, on a loss ratio basis, a lot of these policies without the increases that we've granted have loss ratios well over 100%, which means, they have more in claims than they've collected in premium. And that's unsustainable. And that's not something that, that we can deny rate increases when premiums can't even cover claims. That being said, for blocks where significant rate increases have already been granted, the carriers all talked about assumptions that they have updated. And, there is a limit to how much assumptions can be updated. For instance, lapse assumptions. One of the speakers talked about how they originally had lapse assumptions in the 2 to 6% range. And now they have lapse assumptions of 0.5% to 0.8%. At that point, there is not very much more room for lapse assumptions to come in better than expected. Right. So most of the damage has already been fixed on that specific assumption. And not every assumption is necessarily as bad as it can be, but in general, there is a limit actuarially to how high of an increase could ultimately be needed. Things can't always keep getting worse. Now, whether your block is near that limit or not, we would have to do a lot more delving into the details. But conceptually, there is a point where these blocks get to assumptions that are updated to not only be best estimates, but to have a little bit of margin for things to get worse, and rate increases do stop. And we do have closed blocks that have not had any increases for years. And so, it is not an indefinite thing, but I understand, the frustration and having your rates increase by 127%, that's a huge increase. And, that's what we're really trying to balance. And,
right. And in one of the papers that I received, and I'm not quite sure exactly when I received this because it was not, there's no page numbers on it, but it does say LTC CNF2 Maryland 620. So I assume it had to have been in June of 2020 or something. But it said, we increase your premium by percentages determined by the table below. We will inform you of your right to reduce your current policy benefits without any underwriting so that the required premium payments do not increase, or convert your current coverage pursuant to the contingent non-forfeiture benefit described below, which I thought that just came out this year. So this could have been something I just got. But it said if you were 40 to 44 years old at the age at the time of issue, which I think I was 42 or 43, the percentage of increase over initial premium, 150%. Well, by the time it gets up to the 63.91, it's already at 301% of the original premium. So I'm trying to figure out what happened to that, 150%. So I've already paid like at least that would be like 200% in addition to the original premium. So there's got to be a limit somewhere, because $2,126.53 was my original premium. 150% of that is $3,189.80. So I'm already paying way more than that. I'm paying $4,833. So the percentages don't make sense to me from John Hancock's point of view.
Yeah, I'll have my team look into what you sent us, and I
Okay.
think, I think some of it is communication, and we can show you the math, and some of it is, you know, the specifics for your filing. But it's understood, you know, definitely understand how difficult it is to make this decision, and then, you know, having your benefit reduction, and then, you know, a couple years later getting an additional rate increase on top of that. I mean, we understand.
Oh, no, it's been every year. It's not just, I mean, they held it for three years consecutive based on me dropping that inflation rate. But then the next time they raised it, they only offered me to keep it the same for a year, not for 3 years. I'd be happy if they were going to keep it for another 3 years at $4,833, but they're not. They're going to still raise it every year unless, and if I take a mitigation this year, which I chose not to, not knowing we hadn't had this discussion yet, I just let them increase it. But if I had, and it stayed at the 4202, it would only have been for 1 more year. And that means next year I'd have to give up something else. And the next year I'd have to give up something else. It's not like 3 years from now I'll have to give up something else, a mitigation thing. You know what I mean?
Yeah, understood.
Pretty soon there's nothing left to give up on these things. I mean, what would be the point?
Well, yeah, I will definitely have my team investigate and be following up with you on the numbers you sent. I got the spreadsheet you sent with all your premium history.
I put a lot of time into all this stuff because it just is amazing to me. And I get you can't let them go bankrupt. I understand that part. But
Just to
we
be
can't
clear,
go
I
bankrupt
confirm
either.
Your policy is not part of this hearing. and
Okay, good.
Nothing that could be approved in this hearing would impact you, but I will follow up separately about your policy. But
Okay,
your
so
policy
they
is
have
not
no,
affected by this hearing.
so if that's the case, then they have no other rate approvals for my policy type other than what goes through 2025, correct?
Correct.
15,
That's the
15,
most
15.
recent approval.
They'd have to come back again and you all tell me and blah, blah, blah.
Yes, they would have to come back again in the future. But
Well,
yes,
maybe
I
they
will
won't.
follow up with you, but they're not asking for more increases in your policy right now.
Okay, good. Thank you very much. That's very, I mean, I saw that, but then, you know, I wanted to make sure because you don't know, you know, maybe I'm not reading something right. So,
Yeah, understood. All these policy numbers are very detailed. It's very confusing. There's a lot of different versions out
it
there.
is.
So
There is. Yep. Okay, well, then I can expect to hear from you in the not too distant future.
yes, it's a very busy week right now, but probably next week we'll be reaching
Oh,
out.
yeah, I know. I have till next March. That's when my policy goes up again. So
All right.
I'm good to go for the next year.
Thank you for your testimony.
All right, thank you.
So you
Craig,
said.
do we have
you-
anybody else who asked to speak in the chat, or is this it for the public testimony?
She's-
I'm not seeing anyone else, Brad. I accidentally it took you off video, so I will put you back on.
Okay, well then if we don't have anybody else, then I think that we can call this hearing to an end. Thank you, everybody, for your time today. As a reminder, we're going to keep the public record open for 1 more week. So if anybody listening would like to submit any public comments, please email Craig I. His email address is craig.ey@maryland.gov. And you know, we will publish those along with a copy of this webinar. So thanks everybody for your time today.
Thank you.